Okay, I'd like to welcome everyone to this Master Investor webinar in association with Netwealth. As we all know, COVID-19 has been a nasty shock for many people saving for their retirement. Although equity markets in many cases have staged a strong recovery, the trauma of the experiences of March 2020 will have no doubt prompted many of you to question the resilience of your own retirement portfolios and to think about how you need to position yourself for a post-COVID future. Unfortunately, some of you will also have realised that you were overexposed to some areas of the market that have yet to recover, such as UK equity income, for example, and may need to think long and hard about portfolio diversification and strategic asset allocation. Conversely, you may feel uncomfortable given the strength of the market rebound in some areas despite continued economic upheaval, and are wondering whether you should take some profits off the table. Regardless of your situation, the one thing that everyone needs is a long-term plan that you can adhere to in good times and bad, and will help you to make investment decisions that are in keeping with your long-term retirement goals. This is where Netwealth comes in. Netwealth have supported Master Investor for the last 3 years, having exhibited at the show and presented alongside Jim Mellon on the main stage. Netwealth is an innovative UK wealth manager providing cost-effective, globally diversified portfolios for private investors. It's notably secured the backing of some high-profile investors, and they include Michael Spencer of ICAP fame. Our speakers today are Thomas Salter, Chief Operating Officer, and Matt Conradi, Head of Client Advisory. Tom has over 20 years experience in financial services, the majority of which was spent at JP Morgan, where he was Managing Director and Global Head of Equity and Multi-Asset Quantitative Investment Strategies. Matt, meanwhile, has over 10 years experience in wealth management, and prior to joining Netwealth in 2016, he was Director and Portfolio Manager at Julius Baer and Merrill Lynch, advising and investing on behalf of high and ultra-high net worth clients. Before we begin, I just want to run through a few housekeeping points. So as ever, we are at the mercy of technology. So please do bear with us if we encounter any difficulties. I'm told that if you do have any technical problems, the best course of action is to refresh your browser, but there will be somebody on hand to help with any further issues if you do have them. There will be a Q&A at the end of the session, so please keep your questions coming throughout the presentation. This webinar is being recorded, and you'll shortly be able to find the video recording on our YouTube channel and an audio recording on our podcast. We'd really appreciate your feedback, so please do take the time to complete the short survey at the end. It'll take just a couple of minutes, so please do share your thoughts, as it really does help us improve things in the future. Last but not least, our next webinar is scheduled for the 14th of September. I'll be catching up with Jim Mellon, so don't forget to head over to masterinvestor.co.uk and get yourself signed up for that one. Okay, I think that's everything. So without further ado, over to you, gents.
Thank you, James. So we're going to get started now looking at the content of today's session. Your retirement plans, COVID-19 and the next crisis. What is the long-term impact? So let's start by thinking about the impact of COVID-19 on markets, on economies and our portfolios. We all know that it's been a huge hit to the economy, both in the UK and globally. And I think here the IMF summer projections capture really the economic mood that we face. What we saw in 2019 is that we were having moderate levels of growth in the global economy. We had growth around 2.9%. In advanced economies, that was a little bit less, and we had higher levels of growth in emerging market economies, as shown by the light blue bars there. What we now know, or what we're expecting as of the latest projections from the IMF, is to have a major hit to global economies in 2020. It's expected that for advanced economies, that'll be the largest impact, where we see expectations of a -8% GDP figure for 2020, but then we'll see a bouncing back in 2021. So we are expecting a level of recovery, which is encouraging. It's not necessarily that we're going to have a V-shaped recovery. It's not that we will recover all of the lost growth straight away that we had. And when we think about that more particularly for the UK, the OBR suggested the Office of Budget Responsibility scenarios here helps us think about what the shape of different recoveries might be. And often we hear talk of a U-shape or a V-shape or perhaps even an L-shaped recovery. What this slide here shows is, compared to the forecasts that were in place in March 2019, what are the different scenarios that we might expect? The sort of light grey shaded section is when we are thinking about estimates. The dark blue line at the top was what was forecasted from March 2019, and that was for steady growth. Now, we've taken a hit on the downside, and what do we think the central scenario is? Well, the central scenario is that grey line in the middle, and that's that we do recover, but we don't recover back to the same level as we were at in March 2019 for some time into the course of not next year, but the year after. However, if we have stronger recovery, the more V-shaped, the upside scenario, we would get back there quicker and get back to the trend rate of growth. It's likely that it's going to take time for us to recover from this hit, and there are going to be some overarching changes. Some of those changes will have played out in markets already, and we'll talk about those in a little bit more detail shortly. As we think about what the overarching impacts might be for investors, and in particular those that are considering their retirement plans as well. Well, one thing it has definitely done is it's meant that debt levels have risen in most economies. And if we look here at the UK debt to GDP, it's spiking up to levels that we have only seen on a couple of occasions before. We're looking now at having likely to have debt to GDP above 100%. Which is really quite high levels, and it's something that we have to be conscious of because we've been really easing our fiscal policy. We've been giving away support to various entities to try and protect against the short-term impacts of being locked down and our economies being shut down. But what that's meant is that larger states, the UK is one of them, and more developed countries have really seen their debt to GDP rates rise. Well, what does that mean? How are we going to pay for it? It's something to think about. This is a huge increase in budget deficits, but we shouldn't panic. It's vital that we have a credible pro-growth strategy with consistency between monetary and fiscal policy. If we have that in place and we have an environment of low inflation, low rates, and low bond yields, it is possible that we can grow our way out of this debt to GDP spike. It is possible that we can, with a concerted level, if we think about the right kinds of investment in things like infrastructure and so on, that we can come back with a stronger economy in the future. One of the things that's positive for the UK is the maturity of UK debt is very long. So it's not a problem that we have to focus on in the short term in terms of refinancing our debt at this point. So that maturity is helpful. That is one way in which we could recover from some of this spike in debt that is concerning for people. However, orthodox thinking often prevails, and orthodox thinking suggests that when you have high levels of debt, and if you're on an unsustainable path for that debt, that you have to think about other ways to bring that down. One option that we looked at in the post-financial crisis world was a level of austerity. So that meant that we reined in fiscal spending, but I think the politics means that that's probably not on the table in this case, and therefore there is a risk that the case will be made for tax increases. As a personal investor, you need to think about, well, what will that mean? Will it mean income tax rates going up? Will it mean changes to taxation of pensions and so on? And there's no clear direction for that at the moment. And politically, perhaps some of those things would be more or less palatable as well. But it's something that we need to be aware of. And it means that when you're planning for your retirement, the financial planning element, not just the investing element, will become relevant as well. So thinking about what might happen to tax rates, what might happen for your various elements of your planning that is in place. What did that economic shock mean for markets? We're looking here at the first half of the year, various different markets. On the left-hand side of this chart, we've got the dark blue section is equity markets and various ones across the world. Then we've got some more defensive assets in terms of government bonds, and then perhaps corporate and emerging market bonds. The yellow section is alternatives. And then we think about currencies at the far end. And these are the diversified building blocks that you have for your portfolios. These are the things that you can put into a portfolio that perhaps can help you to think about weathering this crisis and the next, and we'll talk more about that later in today's session about how you might weather the next crisis. But what did happen? Well, what we saw was that equity markets clearly took a major hit. Now, this is looking to the end of the first half of the year, and in many of those markets, we've seen a reasonable level of recovery. So global equities in sterling terms were actually in positive territory by the end of June. In local currencies, they were still down around 5%. And the UK economy and UK markets took a much bigger hit. So global UK large cap equities there, we can see the third bar from the left are down over 15%, and small cap even more so impacted. We can also see that in Europe and in US small caps as well were also a little bit more impacted. But broadly, equity markets as a whole took the hit. What we saw is that classically defensive assets, even though interest rates were low, did quite well. Government bonds provided protection over the first half of the year, and both UK and US government bonds were providing strong levels of protection. Even high quality corporate bonds also provided protection after a while. There was an initial widening of spreads, so the additional rate that is paid for borrowing money as a corporate versus a government bond did widen, and that did impact returns in corporate bonds, but then they recovered. Riskier debt, though, which sometimes gets put into portfolios in order to hunt for yield in the fixed income markets, didn't do so well and didn't provide protection. So not all bonds are protective. The same is true for alternatives. So sometimes alternatives are put into portfolios to provide protection, and they don't always actually provide the protection that we might think. So only some of those assets did help. So REITs, for example, UK property REITs did very poorly. Listed private equity also did poorly in this environment. Whereas gold, it did well and has provided some protection. Whether that will continue in the future is hard to say, but at moments of stress, it does tend to provide some level of protection, particularly in US dollar terms. And then finally, in currencies, what we found is, as a sterling investor, having some form of foreign currency diversification was helpful. So having dollars, having euros or yen all provided protection. And we are a big believer that having some level of foreign currency diversification can be helpful in your portfolios. It does add potentially risk, but it also does add diversification. So the impact of that big economic shock was equity markets took a hit, some defensive assets provided protection, perhaps some of the other alternatives that you might think about providing diversification or protection in your portfolio didn't provide us protection in this period. The other major thing that happened is that 10-year bond yields have come down even further. So we were already at very low levels on 10-year bond yields, but we're now at even lower levels. And we got a convergence of the US 10-year bond yields coming back towards the UK and Europe as well. Now, this means that the risk-free rate, the starting point for the level of return you might get in a portfolio, has come down even further. That means we need to think about that when projecting forwards about our expected returns from various different asset classes, because if your starting point of the government bond is at a lower level of expected return, this generally impacts the potential returns you might get from other markets. And when you're planning for your future, you need to have a sense for what that might mean. It also means that generally yields have come down, so the amount of income you can get from different areas has come down as well. And so if you're trying to target high levels of income, you may be forced to take on substantially more risk, either in the form of credit risk as well in there. So you need to be aware of this big move down in government bond returns. The one thing we should still note, though, that even though government bond yields were low, even in a case like Germany, at the moment of stress, they did continue to provide protection. They went lower. So even though they're low today, they can go lower again. Well, what does that mean when thinking about investing? Well, you have to think about all the elements that you can control, and there is a trade-off between return versus risk. Are you in a scenario where you're going to have to accept lower levels of return for your portfolios, or the returns that you want? So we think about diversified portfolios, and we have 7 levels of risk in our portfolios, from risk level 1, which is closer towards cash type investments, up to risk level 7, which is trying to provide something similar to diversified global equities. And you need to think realistically about the levels of return those different portfolio mixes might give you now. And we can't just assume that a balanced portfolio will give us a nice steady 5% return, which perhaps in the past it has. We think in reality going forwards, those return levels might be lower, and that's something that we have to factor in when planning and thinking about our portfolios and our retirement plans. But what we do know is that picking the right risk level did help to provide protection at the right times. We do know that we can have some level of confidence that in moments of stress, if we have picked a more defensive portfolio, it will provide protection at that moment. And Q1 of this year was a good example for that. This chart here looks at those 7 different risk levels that we have that go from the sort of cash type portfolio right up to the all equity portfolio. And what we see in the yellow dot here is the performance in Q1 this year. The bars either side, the grey bar is the worst 12 months return that we've seen over the last 25 years, and the best 12-month return is the blue bar. So we focus on the downside here. This is the idea that selecting your level of risk will drive the level of potential downside that you might experience in extreme moments. Well, what we see is that in Q1 this year, which felt pretty bad, global equity markets were down some 30%, that the diversified portfolios did the right thing at the different levels of risk. So the risk level 2 portfolio, the second from the left, was well within the -6% range, which is the worst 12 months we've seen before. In fact, every portfolio was well within the worst historic ranges. So if you start with that in mind when thinking about investing in that type of portfolio, that you're going to have to accept what might be the worst historically, what we hope is that we can stay within those ranges. And what we actually see is if we take a slightly longer term view, so we go 1 year to the end of July, that most of those portfolios are nearly now in positive territory. So it's only the riskiest portfolios that are still slightly offside over a 1 year period. So what we see here is that picking the right risk bucket will drive the outcomes that might make you more comfortable or be more acceptable for your process, particularly if you're drawing down in retirement. You might want to mitigate some of the size of that sell-off that could occur at the most extreme moments. We also need to make sure that we think about diversification. What we saw this year is that diversification is not just about having multiple different stocks. They need to be diversifications of style as well. And one area that we know when we're thinking about retirement that investors are often focused on is getting dividend returns. If they can drive that dividend, the theory goes that they spend the dividends, and that will mean they don't have to worry about the capital moves so much. But if you're investing just in dividend focused strategies, even if you have multiple different funds, you are experiencing one specific style. The same is true if you only invest in the UK as well versus just investing in global markets. And what this chart here shows you is over a range of different periods. The dark blue section is year to date to the end of July. The light blue is a 1 year, and then the grey is a 3 year, and the yellow is a 5 year return. If we start on the left hand side on UK dividend focused companies, well, it's been a pretty torrid time on a year to date basis. We're down nearly 35%. If we've been more diversified in the UK index as a whole on a year-to-date basis, well, it looks better. It's down about 20%, but there has been some companies that have benefited on that and haven't suffered by cuts from dividends or perhaps the sectors that high dividend have historically been high dividend payers. And then if we look at the MSCI World Index, well, actually, if we do that in sterling, so we're getting the benefit of currency diversification as well, then actually on a year-to-date basis, we're slightly positive. So what we can see there is that you need to think about your diversification, not just in terms of the number of companies you invest in, that providing that element of diversification, you need diversification of styles as well, and not focus all in one direction. And we'll talk more about that idea of not just being focused on income in a bit more detail in the next section. So at that moment, I'm now going to pass over to Tom, who's going to talk more about investing for drawdown and preparing for the next crisis.
So Matt, sorry, just to chip in there, we've had a lot of macroeconomics in that section.
Yes.
Is there a sense that investors sometimes fall into the trap of worrying too much about macroeconomic issues and, you know, all the economic headlines and things that are completely out of their control? And would investors kind of, you know, be better served by simply concentrating on process and strategic asset allocation, that's things that actually are within their own control?
So I think in general, yes, if you take the long-term view, the biggest driver of their outcomes is going to be their strategic allocation, making sure that they have avoided some of the major risks, so being properly diversified and so on, it does matter. But you can't ignore the macro environment that you're in, particularly when you're at a turning point. So it's important to set that strategic mix and think about the macro that's going to impact on it, and make smaller adjustments around it. So don't swing around based on economic output. Remember that economic data is often lagging, so we're going to get a lot of negative news about GDP over the next few weeks and months, but markets have already priced that in and moved on, so don't get too focused on that. But you can't ignore the macro altogether, and you need to understand what that might mean for longer term trends. So when we think about macroeconomic data, we're more interested in what it might mean over a sort of 1 or 2 year period for rotations in sectors or markets, rather than the latest figures from jobs data, what that might mean for the S&P on the given day up 1 or 2%. That leads to trying to chase markets too much, and that's very difficult to do.
Okay, Tom, over to you.
Thank you. We're going to move now more into thinking about, what effect some of these aspects have on drawing down, and what things we might be thinking about as we look forward. And and front of mind is, of course, well, what is the next crisis, or how is this one really going to unfold in the medium term? But we'll start with, investing is a long-term game. And very much, things that happen, crises happen, crises pass, and if timescales are long enough, we're all really here discussing this because the typical sense is that long-term investing makes sense. It's always interesting to look at, well, what if it's about to happen? What if we're about to fall off the crisis cliff, so to speak? And this case study looks at this investing in a drawdown portfolio right at the start of the financial crisis, and how that would have evolved up to the end of July this year. And really what you can see, that the dark blue line is showing the 500,000 starting balance with a withdrawal of £36,000 a year, and that is ultimately invested in a balanced portfolio of equities and government and corporate bonds. And showing the value that investing can bring over and above a cash portfolio, which is indicated in dark grey. Even starting at the beginning of the precipice, if you like, how that over the course of 12 years has unfolded to give a significant incremental added value by making that long-term investment versus not. So when you're thinking about when should I invest, what should I do, and some of the potentially knee-jerk or not being knee-jerk that Matt was talking about, it's important to be considering what timescales we're talking about here. And the shorter that timescale, clearly the bigger the impact any crisis can have on net results for my withdrawals. So looking at the next slide, and going back to what Matt was talking about, income and total return. So what we're talking about here is the intuitive and very natural desire to think, well, what I don't want to do is spend or pay down or withdraw any capital, and I'm just gonna take the income from my portfolio, versus thinking about a drawdown portfolio in the context of the total returns that are available to me. So really withdrawing some of the growth, firstly, the capital growth, but also thinking about withdrawing the capital, because both are important as we think about what is a drawdown portfolio supposed to be. But the broader thing to look at here is if you invest purely for income, the temptation really is a style drift, you might call it. You're moving into higher dividend stocks, or as dividend yields or overall yields are coming down, how are you looking to increase income to back to where it used to be? And it's a very it's a very sort of feedback loop that generally pushes people into crowded trades, into portfolios that lack diversity of sources of return. And whilst that might be a sensible, intuitive way to approach things, and I'll leave my capital untouched, what you're doing is foregoing returns in many cases. The total return approach is less intuitive. It needs more discipline about the thought of, well, withdrawing some of the capital, but what it gives you is much better potential diversification. You can look across many more sources of return, including elements of growth returns that you can then withdraw and spend. Now, in terms of has that historically like for like, if you think about the equity elements of that, the dividend payers have somewhat been stable sometimes. And that's, so there's a perception that the total return and growth can bring a bit more volatility, which is true at times, and perhaps you need a higher risk tolerance to look at that. But ultimately, what you're looking at then is trying to get the best possible returns from the market, rather than just thinking about the one track of, I'm going to leave my capital units untouched. Of course, it also means that a withdrawal strategy is something that needs to be carefully considered, and more about that as we go through. Moving on to an investment approach, when you're thinking about diversification, what is the right way to think about it? What we've laid out here is really Netwealth's approach. There is no right and no wrong, as you all well know, but when you're thinking about long-term investing, and you're thinking about that in the context of the relative stability that you want from a withdrawal or an income drawdown portfolio, a retirement drawdown portfolio, the diversification of returns, the ability for different asset classes or different regions to give you positive results or less negative results when others are underperforming is paramount. So we think of the strategic allocation as, what is, if we had our hands tied behind our backs, what would we invest in for the medium to long term, in terms of looking through the lens of in this case, let's say a sterling investor, and B, at the specific level of risk return that the client has chosen. And it's important that that lens is looked through properly, because if I were looking through from the perspective of a higher risk or a lower risk investor, or an investor in a different currency, the allocations could be quite different. And that's something that we will actively reappraise infrequently, but with discipline. But we don't expect to make changes typically, because we are relatively confident in the analysis that we've done for our long-term strategic allocations. In terms of implementing those allocations, Netwealth is implements typically, and certainly for very mainstream assets, with a passive allocation to an asset class or a region. So we will actively pick the right instrument, but that instrument is typically passive. We don't rule out the use of actives. But in the mainstream markets, there is an overwhelming research that stock picking in the long term is an extremely hard game. And if you're thinking about that across 10 to 15 different asset classes and regions, being able to pick the right person to make those picks and those calls in each of those asset classes, the statistics are so heavily weighted against you that our preferred approach is taking a much lower cost and diversified passive approach for that implementation of the specific asset classes, which we think gives our clients the best chance of the best returns in the medium term, medium and long term. But things change. Situations change, situations evolve, and we are constantly looking at what changes we might like to make, what we might term cyclical positions, so cyclical changes. Typically, these might be risk mitigating changes to portfolios. So if we think that there is a specific risk-reward profile that is imbalanced, we will make a change to try to make that, put that into a better position for the potential range of outcomes. And this will all be driven by, yes, the macro economic environment that's going on, whether it's policy and government behaviors or potential behaviors, as well as fundamental data around, whether it's valuations of equities or currencies, all of these, so quantitative and qualitative inputs to that process. The results on the next slide, I mean, what we give you is a sense of our strategic allocations for our sterling portfolios. Over on the left, you can see something titled risk level 1, and it goes through to the other end at risk level 7. Risk 1 being the lowest risk and heavily in investment grade corporate bonds and cash and money market instruments, through to risk level 7, where the majority sits diversified across global equity exposures, and then some, if you like, riskier fixed income or bond exposures additionally. And ultimately we use those strategic allocations. The cyclical positions will change those slightly, but we will remain true to a high risk portfolio if we have been given a high risk mandate. So we will be tweaking, we will be changing, we will be reallocating sometimes particularly different regions or different adjusting some of the currency exposures. But our if you give us a high risk level 7 or mandate, or a risk level 4 mandate, we will remain true to the principles behind that mandate. So thinking more about diversification and its benefits on the next slide. This shows which have been a rank of the top performing asset classes in the 10 years following 2008. So it's an interesting slide to consider, less for exactly what was where, and more to show that really it's very much a random quilt, if you like. When you look across the years, it is incredibly difficult to know which asset classes are going to be at the top of the pile. And the benefits of diversification really, what are we looking for from diversifying across different asset classes, different regions, is really to be able to participate in some of those best asset classes through any given year, and give the portfolio in question the best chance of making positive returns, making the best positive returns for the given level of risk. So if you think diversification is doing two things, it can allow me to take more exposure for a given level of risk, and it can give me different sources of return from which I can benefit. The strategic allocations, I suppose, really reflect this. The cyclical positions that we might do are going to be more influenced by our perception of some of these asset classes, but there is no magic. Nobody knows the answer to where these asset classes are going to end up. So when we think about cyclical positions, it's very much looking at scenario analysis. What could happen, and is there a particular imbalance that could affect our clients adversely? The next slide shows how volatile markets can be, really. And when you've had a 10% down move or a 20% down move within a year, that's clearly a very worrying statistic, a very worrying piece of data, and that's going to translate into lower capital values in your portfolio. It is worth pointing out, though, that up years, so some very significant positive return years, have also had inside that year, intra-year, significant drawdowns. So everything needs to be thought about in the context of what could the range of returns be, and the question of how you choose the risk profile, the mandate that's right for your portfolio and the right for your drawdown, is thinking about how this volatility can affect your withdrawal schedule, how long your money can last, but also how your reaction to those moves can impact the decisions that you may subsequently make. The next slide starts to think about the role of bonds, and bonds is a big question these days with the low level of yields. And the obvious question is, why have bonds at all if the yields are so considerably low? But of course, when we're thinking about portfolios that try to balance risk and return, and that's particularly important in the withdrawal portfolios, so portfolios that you are drawing down and using the proceeds of to live on ultimately, as in the case of a retirement drawdown. That stability or improving the stability of returns is very, very important. And bonds still ultimately have a role to play, albeit in a low yielding world. So Matt mentioned earlier the drive down of yields over time, and that's a trend that has been happening for 20 years plus ultimately. The ability though for bonds to provide positive returns when equity markets are losing has been consistent over time. Now, we've seen in the extreme German bonds that were negative yielding bonds, they became even more negatively yielding as equities dropped. They provided some investor protection, even if you think locking in a negative yield is a bad thing. Now, that's a more extreme case, and we're not yet there in the UK. It's a questionable allocation to make strategically to a negative yielding asset. If you can get a zero, then that might be perceived as better. But equally, you've got to think about some of those path dependent aspects, particularly for drawdown. For us, bonds still have a role to play. It's also important to think, when we're looking at these bonds, UK government bonds are not the only instruments available to us. G7 government bonds globally are also there. So we have allocations, for example, in the US government bonds, which we hedge back into sterling. So we take away the currency risk and provide some US dollar government exposure that once the currency hedging has been taken into account, can provide a better yield on an ongoing basis than UK government. We also look at corporate debt, so high quality company debt to provide additional yield and when you're looking across the risk return spectrum, that corporate bonds, high quality corporate bonds, features very highly in our portfolio. We saw a little bit highlighted in risk level 1, but also through to risk level 5, there's a good proportion where the additional yield you can get is very much, in our eyes, worthwhile from a perspective of the risk return. The additional risk is worth taking for that additional yield. And lastly, when we're thinking about diversification, we also want to think about currencies. So currency exposure is very important. We've highlighted here one particular currency pair, so that's how much a yen is worth in sterling. And this tends to be very counter-cyclical with respect to equity markets. So if you think the yen is viewed as a safe haven currency, you have others. Dollar is often, but not always, a safe haven currency. Things like the Swiss franc are sometimes mentioned in this context. But these currency exposures are also important when you're thinking about diversification of return and how market moves down in global equities can be offset somewhat by other assets or other exposures that you retain in your portfolio. So for this reason, our strategic allocations include unhedged exposure to Japanese yen assets, including Japanese equities. So we're going to move on to the next section, which really covers, things, start to think more about planning of a drawdown portfolio, what the things we can and can't control, and translating a little bit the behaviors, the potential market behaviors into what it means concretely for a client who's drawing money from an investment portfolio.
Tom, I just want to pick up on what you were saying about government bonds, because I completely get the notion of government bonds being a good diversifier for for equities, especially, I mean, in the short term that would seem to obviously be the case, but looking to the longer term, surely given the current yields available on government bonds, the outlook for government bonds in the long term is pretty horrific, isn't it? Isn't there an argument for excluding them from portfolios altogether at this point, if we're looking at a long-term view?
I think, yeah, there's definitely an argument, and as yields go inexorably lower, that argument definitely gets stronger. So if you think a strategic allocation to a German government bond yielding minus 0.5% or something, that seems incredibly counterintuitive, and for us, equally so. When you're thinking about this, though, you have to look in the broader context of what alternatives you have in front of you. So at one end of the spectrum is a portfolio that has no bonds at all, but of course that comes with significant risk. And when you're thinking about taking significant risk and moving your portfolio into drawdown, of course, that may not be the right approach, whether it's the timescales involved or whether you as a person and your natural reactions to taking that risk are not a good fit for that decision. So what are the other choices that you have at your fingertips? I mean, there's cash or cash-like investments, but of course those are also incredibly low yielding, and in the context of the UK and corporate debt, US government bond debt, sort of the mainstream tools in front of us, for example, cash doesn't look very good in that context either, especially when you're thinking about longer term, medium and long term investing, as in the case for drawdown portfolios. So a sensible balance of thinking, well, government debt doesn't look very good. No. Do I rule it out completely? Possibly not. Let's not be too hasty. But let's also look sensibly at where we can go on the high quality company debt, so the investment grade corporate debt that we talked about, which provides significantly higher yield, and we think very much pays for itself in terms of the additional risk involved, but also looking slightly more intelligently at what government risk is available, such as the example I gave of US government bonds. But yes, coming back to your question, it's a very tricky one, and what really is the worst outcome of that thought process is people saying, well, I'm going to start chasing yield somewhere else. So look at the maybe they're thinking of property, so I'm going to buy some UK real estate investment trusts or some asset-backed debt investment trusts, which may be very, very good assets in the long term, but of course come with very significant volatility of capital value or perceived capital value as well. So chasing yield in a lower yielding environment is tempting, but also might put you at or even above the equity risk that you were trying to get away from. I'm going to go back to the thought around starting to think about the financial planning aspects of drawing from an investment portfolio. The first question that really needs asking are what are you investing for? And in the context of retirement income drawdown, that may be a simple answer, and it may be not. But always, whatever investment goals people have, it's one of the first things that needs asking and being clear, both with yourself or if you're speaking to an advisor, with an advisor, to think about what you're hoping to get out of this money before you can start thinking about what that money goes into. So it may be it's retirement drawdown, maybe it's an ongoing drawdown fund for paying for school fees or education fees of some sort. Building up a capital value for a specific reason, whether it's a purchase or paying down debt like a mortgage, or it may just be something for which you have no idea. And I mean, we see this we're in the context of retirement. Some people will assign some of their retirement funds to drawing and providing an income during retirement, but also set aside some funds for which they don't feel they'll want to or need to draw from, and put it aside for the next generation. And so that has a sort of a less specific purpose, but putting these sort of reasons, rationales out is the right starting point, because you can then work backwards to think about what you invest in and how you invest, and how those decisions are going to affect you in the context of the range of different unknowns that are out there. There are many unknowns. We don't know what they are, but the first one, I suppose, that we look at in the next slide, thinking about risk. What's the potential for losing money? What's the potential for making money? The more risk you take, typically the more return you may get. But of course, the more negative return scenarios you're likely to encounter as well. When people think about moving themselves into an income, a retirement drawdown portfolio, the typical step is to take some risk away from their portfolio. You are shortening your timescales, but you're also introducing the need to keep withdrawing, the need to keep selling down, which people are always reticent to do on significant losses. Even if those losses are short term, you'll then you're capitalizing those losses by making the sale just to cover that income portfolio. What we've laid out here are, okay, how do the different levels of risk across our portfolio risk spectrum behave over a long-term period? So this is based on our strategic allocations. Over a 1 month period, the proportion of time that these portfolios produce negative returns are roughly a third, and consequently in 2/3 of scenarios they're producing positive returns over 1 month. As you go out over that time period, so 6 months and 1 year, you see the lower risk portfolio, the number of times they produce negative returns over those slightly longer time periods come down substantially. All of them come down, but you would still say that a risk level 7 is, at just over a quarter of the time, it's still producing negative returns based on historical values. But once you get to 5 years, that the low and medium risk examples, so the risk level 2 and the risk level 4, historically have not produced 5-year periods of negative returns. And by the time you're getting to a 10-year time horizon, that risk level 7 is approaching 0 for that strategic allocation in terms of the number of times it has produced negative returns over a 10-year period. But these are important aspects to be thinking about. Timescales for income drawdown for your retirement funds, they're typically relatively long. If I'm drawing down from age 65 onwards, that's a 35 odd year potential time window. The average of that, I suppose, is much less. So, half of that we would say, so it's somewhere in the region of a 15-year time window. But equally, as I said before, it is path dependent, and you have to think about, the behavioral aspects of that. Once you start thinking about those returns, there are also other aspects. So we've talked about investment returns, but there are other aspects that you can't control. Outside your control is your own life expectancy. It's a pretty important factor from a personal perspective. But price inflation is another. It's another external factor that we need to think about. So withdrawing £1,000 now to be equivalent in 10 years' time, we're going to have to withdraw substantially more. We can't just think about withdrawing £1,000 now. But luckily, there are things that you can control. And this is where, as well as picking how you invest, the right level of risk for you and your retirement funds, the age at which you start taking income, and whether you start by taking a smaller income and continue to work part-time, or you push it out, you have the ability to work for longer if that's what you choose and can do. And also the target income that you want to take, and how flexible you are around that target income. In times, can you tighten your belt if things have taken a downturn to give your funds a better chance of recovery? Now, all of these variables we need to take account of, and more importantly, model for those different scenarios. So just touching on life expectancy, though, before we start looking at how we might think about modeling those, I mean, the real risk is that you live longer than the sort of national statistics might say that you're going to live. And that's obviously a good result generally for people. Everyone would like to, but the important thing is that you allow for the fact that you might. Going on an average life expectancy from a particular age, you run the risk of drawing too much, your funds running out, the good result that you might live longer, with the bad result that you don't have the money to sustain it. So when we're thinking about income drawdown portfolios, we're definitely looking at the upper end of where you might live to, important in order to be able to sustain that income over time. And this is of course something that we'll need, as markets evolve and as time goes by, that needs to be reappraised every few years. So you can think about if you need to make adjustments to your target income or your expectations or your lifestyle, that can be done. We're going to look at a case study demonstration, and Matt's going to take back over and do that using some of Netwealth's planning tools that are available online.
Thanks, Tom. Yeah, so we'll just have a quick look at these planning tools and a specific example. So we've talked about protecting for a crisis, being diversified and so on, but planning is important, thinking about those controllables or not elements. And we're going to look at an example here of someone who's targeting £4,000 a month of income in their retirement. They're age 50 today, looking to retire in 10 years, age 60, and they're going to factor in a retirement of 25 years to age 85. They've got a pension account that they're going to invest that in. They've got £750,000 in that pension today, and they're going to keep making some monthly contributions of £750 a month net of tax before, so they're going to tax gross up until they retire in 10 years' time. And they're going to invest at risk level 3. Now, risk level 3 is, as we mentioned, a diversified portfolio. It's got the blue section here is 60% in fixed income. The green section is 30% in equities. It's well diversified across different regions. We talked about having some US government bonds and UK ones. You can see there a whole host of those different elements of diversification in the portfolios. What does that goal look like? And this is the point. You can start to model how realistic the target of £4,000 a month of income is going forwards. And it looks pretty rosy here. The projection on the left-hand side shows a range of outcomes that you could get. And on average, the dark blue section in the middle, they'll meet their goal of that £4,000 a month and have £400,000 remaining. However, they've missed some of the uncontrollable elements here when modeling. They put 0% in for inflation. Well, let's put in a long-term expectation of 2% for inflation. And then let's think about perhaps longevity risks. So let's factor in living instead to age 95 versus 85, and then rerun that projection. So you can now change those parameters and see how realistic that is. And what we see now is in the projection is it's pretty unrealistic that they're going to meet that goal, because inflation has meant that the starting point of 4,000 today actually ends up at nearly £10,000 a month at the end of their retirement period in July 2065. That's the impact of inflation over time. So they might have to consider changing a few things. Perhaps they take less income, so bring this down to £3,250 a month. And that will get them a little bit closer. Again, they can rerun that projection and have a look at what that means for the outcomes. And we can see it's got a little bit better, but it's not all the way there. The reality is this is a really long-term goal. This is over 45 years worth of investing. perhaps they need to consider taking a little bit more risk. With interest rates where they are and expectations for return lowered, they might have to consider taking a little bit more equity risk. And this in risk level 5 portfolio now with 60% in equities might be more appropriate for that long time frame they've got for investing and the level of return they need. So let's look at that updated projection. Now we can see getting an average return of 4% per annum, that goal, that target, more realistic. So they controlled the elements they could, the level of risk they took and the amount of income they targeted. Another parameter could have been deferring their retirement a little bit. But what you can see here is modeling out this will allow you to take much more informed decisions about what is and isn't achievable going forwards. These tools are available to you if you register on our website. You can access them completely for free and do your own modeling to your own specific circumstances. So let's just summarize quickly what we've gone through today. COVID-19 will continue to have a major impact on the global economy and markets, and we need to be aware of that. But we should think long term and not get too fixated on the economic impacts in the short term. Make sure your portfolios are truly diversified to protect against the next crisis. So think about keeping some government bond allocations in there, or some at least other risk reducing assets, and uncorrelated ones such as foreign currencies. Consider a total return approach for maximizing your retirement income. Focusing just on dividends will not mean you're diversified. And whatever you do when you're thinking about your retirement, model for the outcomes so you can make a more informed decision. If you want to speak to some of our team, you can get in touch with us at advice@netwealth.com. We have a team of advisors available to give you guidance, help you with those tools, or just talk to you in more specifically about your outcomes. I think now though we're going to look at a couple of questions, and I'll hand back over to James for that.
Thanks, guys. So first question from an audience member is, fundamentals are divorced from valuations. When will the inevitable crash be? Do you guys worry about valuations? Keep you awake at night?
Yeah, I think you've got to focus on valuations and factor those into portfolios. The strategic allocations think about long-term returns that can be achieved, but valuations will drive cyclical adjustments. I think high valuations can last for a long time in a period of very low interest rates, a lot of monetary policy easing. We've seen that with the US market. It can be highly valued for a long period of time. And so you shouldn't be the only driver, but you should factor that in when thinking about making adjustments. I think the crux of that question suggested, though, that perhaps the person asking it was considering when to sell out and to avoid that crash. That's not what we think you should do. Make an adjustment from perhaps a more highly valued market to a less highly valued market, maybe move from the US growth stocks, the FANGs, into more European stocks perhaps. But we don't think you should try and time getting in and out, because that's extremely hard to do. And it's more likely that you'll destroy capital rather than add value.
Okay. Next question, should we consider taking the 25% pension lump sum now? And I think this relates to the talk around the potential for the Chancellor scrapping the 25% tax-free lump sum on pensions.
Yes, potentially it does, and that's something that's been talked pretty much for the last 3 or 4 years on and off, that scrapping that tax-free lump sum. I think the key here is you should really plan based on the rules that face you at that moment. It's unlikely that they would scrap the 25% tax-free lump sum without giving you some lead time around dealing with that, because you need to be careful about not letting the tax tail wag the dog. Think about the planning. If you're planning on taking your tax-free lump sum in the short term to pay your mortgage off, well then perhaps yes, accelerate that process and get on with it. If you're not planning on doing it, be careful, because you're going to take that money out of a nice tax-free wrapper that's a pension and put it into a taxed environment. Some people will take and leave it in cash and not invest it. That's something to avoid. It's also in your estate. Pensions are outside of your estate at the moment. If you take the tax-free lump sum, you bring it into your estate. So it's not as simple as just doing it because there might be a change to the rules. Generally work within the rules as they are today, and think about your specific circumstances. This is often where talking with an advisor around your plans can help you make a more informed decision about the right thing to do there.
Are you guys worried about the systemic risks posed by the rise of passive investing and ETFs?
Maybe that's one for Tom.
Yeah. Well, I think there's a little bit of an element of fear where doesn't really exist. I mean, you've got to look at what's inside any vehicle before you can think about what's a systemic risk caused by it. A passive investment, what we're talking about here, and certainly the assets that we will buy, they are fundamentally liquid building blocks inside those funds. They are, an S&P 500 ETF or a corporate bond ETF. Those are buying the most liquid instruments, the most frequently traded in markets and asset classes. And the idea that somehow the ETF is not the sum of its parts, that divorce from the two really isn't something that happens any more than an intraday type of period. In terms of is investing on the second question, I suppose, is how the indices are weighted inside an ETF. So what is an ETF tracking? Now an ETF might track that S&P 500 or that FTSE 100. Those are market capitalization weighted indices. So to the extent something is coming into that and buying the whole thing, that is not moving relative valuations at all. What's moving relative valuations are other aspects of the buying and selling of those equity investments. So there's sometimes sort of fear talk of, well, aren't passive vehicles driving up already high valuations? Well, what it's doing is driving up valuations across the board. If there are keep being systematic inflows into passive vehicles, but equally that's true of active funds as well, or of people buying equities more broadly. If you think the average purchaser, are they purchasing on average a market capitalization weighted portfolio across the millions of investors they're doing? I mean, that's fundamentally roughly where it is. So I think there's an awful lot that is overblown, particularly in very liquid markets. And I think the bigger question that's a very good one is around corporate governance and the need for passive vehicles to be involved and very active in making sure that companies are held to account. So, and the engagement of a Vanguard and a BlackRock, the two, State Street, the big players in the passive vehicle market, I mean, they are all on top of this. They don't have the means to sell out, which is another argument that comes along with corporate governance. But equally, there is also the argument much better to be a powerful voice at the table than just simply walk away from the table if you want to sort out corporate governance. So overall, I think it's just generally a little bit overblown. Where you do need to be careful is where you're buying what is an ostensibly a liquid asset, but has less liquid things inside it. So where the liquidity of the ETF or the investment trust, which is another example of daily traded vehicles that contain other things, it might be that things inside are less liquid. So in the world of ETFs, that's particularly true in places like high yield bonds. So you have much less liquid instruments inside than the liquidity of the ETF. And of course, that's where you've got to be very careful, go in with your eyes open as to what those liquidity risks would mean. It's a widening of spreads. It's a divorce from a theoretical mid-market of the bonds to what the mid-market of the ETF might be. And actually, we saw a little bit of that in some of the less liquid debt ETFs during the coronavirus crisis. But actually what it turned out is that the ETF was reflecting the true value of the bonds inside at that point in time, rather than a theoretical mid-market. Spreads do widen. And if you're choosing to invest in those instruments for risk return reasons, you need to be aware that if at a certain point you want to get out, and that point happens to be in a crunch of liquidity, like we've just seen, that will affect the total returns. But the ability to sit through that is equally means that you can afford to take some of that liquidity risk and be compensated for it as well.
What about the fact that a lot of the market capitalization in the US now is concentrated in a handful of companies? And I think it's actually at historic highs, isn't it, now, in terms of the amount of market cap that's concentrated in the top 5 companies, is it? So when we invest passively, do we kind of do we expose ourselves in terms of, you know, the fact that a big chunk of our portfolio is concentrated in these companies?
Yes, you do if you just invest in one index.
Definitely take it.
Sorry, Tom. I was just going to say that if you pick just one index, then that is a big risk. There are pros and cons to passive and active investment. We can't pretend that just investing actively means you get rid of all the negatives that occur inside a passive fund, because actually many of those, the reason those stocks have become such large parts of the indices is because active managers have been bidding them up to much bigger weights in their own portfolios. I think the key is to look where the issues are and to diversify. So to hold a mixture of indices, so counterbalance some of that. We do not invest in line with the MSCI World, for example, because we think it is overly skewed towards the US. So we have a more diversified exposure. You don't have to invest in the S&P 500 in order to get US equity exposure through an ETF. You can readjust that. You can put more small cap allocation in. You could go to sector levels. So it's accepting what is good about an ETF, which is it's low cost, it's liquid, it's easily tradable, but understanding that actually tracking using market capitalization might be a bad idea, or the Dow as a tracking it as an index is a strange one because it's based on the price rather than even the market cap. So just understanding those risks.
Okay, I think we're going to leave it there, guys. Thanks. We're already running slightly over time. So I just want to thank you for being panelists today, and just to say that if everybody could just take the time to complete the survey at the end, we'd really appreciate that. And thanks to everyone for listening. Take care.
Thanks.
Thank you, James. Thank you all.